Okay, dear brothers and sisters, and very good afternoon. So today we will start with the topic in chapter 8, audit planning and analytical procedures. So the first learning objective is to discuss why adequate audit planning is very important. So we will discuss this in the first objective. There are three reasons that we need the planning in the beginning of the before we start the actual audit process. So the audit, the first reason is to obtain sufficient competent evidence for the cases or the circumstances. So we need to ensure that when we do the planning, we will ensure that when we collect the evidence, we collect the sufficient evidence due to our planning. So it's kind of, let me give you an example. Uh, if you go in traveling, you go, let's say you want to go to travel to Langkawi, and you didn't do proper financial planning. So you reach, let's say you take with you 500 ringgit, then you reach there, you will have, it's most probably you will have shortage of cash and money. But if you have proper planning, you will ensure that sufficient money you have for this trip. Same thing, we can bring this reason to the audit planning. So we need to bring we need the audit planning. We need the planning process in order for us to ensure that sufficient and competent evidence that we collect for each client company. Okay. Number two, to help keep audit costs reasonable. This one is related to the finance or related to the cost, because when we if you remember, when we discussed in last chapter last week, we discussed the audit evidence, and then we have the scale of the evidence, the 8 evidence we have. Some of the evidence are costly, some of the evidence are less costly, isn't it? We discussed, let's say, if you still remember, the documentations as one of the audit evidence, which is less cost, and also acquiring information from the client. This one also less cost. But if we get the physical examination and also observation, more is more costly. So auditor need to ensure that the cost is minimum. We balance between the cost and the appropriateness and sufficiency or persuasiveness of the audit evidence. So we need, if we conduct sufficient and efficient audit planning, it will help to keep audit costs reasonable. The third reason, to avoid misunderstanding with the client. This reason is, let's say if we didn't have plan, we didn't conduct the audit planning. So we keep come up with new things in the spot. So we tell the client, okay, please, today I need to or tomorrow I would like to come to do examining the inventory. Then after we finish, then after maybe 2 months or 1 month, then we ask to do it again, or to do to extend to do something. So if we do planning and then we inform what we need from the client, is this one and this one, we acquire this kind of information, we need to conduct to contact some customers of the client and some suppliers, and we give them some clear planning structure that will help too much to reduce the misunderstanding with the client. If you remember, last week we discussed that the audit program will drive to the audit planning, and audit program is kind of audit procedures that we will conduct during the auditing. Okay, so that is the three audit planning, the three audit reasons to have audit planning. So let's discuss now the planning and audit discussion, and discussing and designing, sorry, the planning and audit and the design of audit approach. So we let's say what is the design and approach for audit planning. Number one is accept the client perform initial audit planning. So this one in the beginning, or in the beginning of the relationship with the client, in the beginning of the relation with the new client. So we need to accept the client or not. So, and so for this one, we need to conduct initial audit plan and to perform some engagement procedures, whether to accept or not. Next is to understand the client business and industry. So in this stage, if we start to in the stage of planning, we need first to accept the client or not. If we accept, then we need to perform initial audit planning. So the next step is to understand the client business and industry. So especially if the client from industry that we did not perform, or we don't have similar client from the same industry. So what we need to study and understand the client business, and in term what is the natural, what is the nature of the business, one thing. Now, how much they are in terms of size, in terms of are they local company or international company. All of that will bring a better understanding of the client. And then we need to understand the industry. And when we say industry, we need to understand the risk related to the industry, the benchmark related to the industry. Also, we need to understand some issues, some advantages, if there is any requirement for high expertise in this kind of industry. Let's say if the industry is software industry, so we need this kind of industry is high risky in terms of inventory, because the software is difficult to evaluate, one thing. And then the next risk is related to the expertise. We need someone who is expert in evaluating the software and knowing how to handle the industry. Okay. And third one, we need to assess the client business risk. So number one, accept the client if it is new and perform initial audit plan. Then two, we need to understand the overall client business and industry. Okay, so if we already build a better or obtain a good understanding of the client and business and industry, so the third step, we need to assess the client business risk. So what is the risk related to the client? Either it is inherent risk related to the industry overall, and whether it is related to the company internal control risk that we discussed in the previous chapter, in chapter 10 actually, but we discussed it last week already. Okay, then the fourth step is to perform preliminary analytical procedures. And when we say analytical procedures, it should come to the mind that we need to perform certain financial ratios in a basic manner. Let's say we need to get the return on assets, we need to get the return on equity, we need to get the liquidity ratios, the carry ratios, and so on, and leverage and the other ratios as well. All of these ratios, we can compare it with the benchmark ratios of the industry or some competitors companies, to build and to enhance our understanding of the client, and also to conform the assessment of client business risk in the step before. Okay, so we still with the same. So in this, then what we need to do also in this stage of the planning, we need to set materiality and assess the acceptable audit risk and inherent risk. Materiality, we already discussed what is materiality in Ramadan, but we have that video in the in YouTube, so you can refer to it. And next week also we will have some case study about that, about the materiality. So materiality, in a sample way, it is the significant. Is it matter? Is this misstatement matter? Is it acceptable or not? If it is material, mean it is a matter. It is the auditor should give attention, and it will affect the auditor opinion in the stage of completion and reporting the financial statement. And then assessing the acceptable audit risk. So auditor in the stage of planning, he need or she need to set up the acceptable audit risk. And as I said, acceptable audit risk should be as minimum as possible. Okay, so and we need to assess the inherent risk as well. Inherent risk is the built-in or the natural risk that related to the business. So as I mentioned just now about the software industry or financial industry, those who has cash, so they need to ensure that the security, they need to ensure they have locker, they have CCTV, and so on. Okay, so then they need to understand the internal control and assess the control risk, and then gather information to assess whether there is a fraud risk. Okay, then lastly, develop overall audit plan and audit program. If you notice, the last stage, which is develop overall audit plan and audit program, it you see it is like consequences of whatever we have from the beginning of the steps. So we understanding, accepting the client, having preliminary analytical procedures, doing assessment of risk, then assess the internal control, assess the inherent risk, assess the fraud risk related to the financial statement. All of this will shape the audit plan and audit program. And it means the audit plan, it will direct how much work we need to conduct, and what expertise we need to have, and how long time we need to do, and that will affect directly the audit evidence collection in terms of volume, in terms of type, and so on. Okay, so moving to learning objective 2, making the client acceptance decisions and perform initial audit planning. So making client acceptance decision and perform initial planning, this is the first stage or the first step that we mentioned just now. We will explain what does it mean. So initial audit planning is the client. We need to differentiate between the client acceptance and continuous. What do we mean by client acceptance and continuous? Because we have two types of client: new client and existing client from the previous years. It means that client that we audited the financial statement for the prior years. So in the case of accepting new clients, we need to conduct more in terms of understanding the industry, understanding the client business risk, and also as well as the internal control risk and so on. Okay. And then, but for the continuous client, what we need to, sorry, we need to ensure that that we are using the prior year assessment, finding of the auditor related to the internal control and so on. If there is any significant changes, either related to the client business or related to the industry, so we need to put it in mind to for the continuous auditing. For example, now we have what we call the COVID-19 case or COVID-19 pandemic. So in this case, it is something will affect the whole business environment. So we need to assess the risk related to COVID-19 related to the client business, either it's new or continuous client. Okay, next is identify the client reasons for audit. Okay, so what we mean here, we mean why the client would like to have auditing, especially with new client. Is it because they want to because there is a few reasons. One of the reason is to fulfill the requirement. It's one of the requirement to be listed in the Bursa Malaysia or in the stock exchange market if it is public company. And one other reason is to apply for loan, from the bank uh, or other financial institutions. So they need to have audited the financial statement to be audited. So for that reason, we need to understand the reason behind the client motivation to be audited. Okay, then we obtain an understanding with the client, then develop overall audit strategy. And here in the initial audit planning, we build or develop overall audit strategy, and we, let's say the client company is willing to or planning to apply for loan, let's say. So in that case, we will build the strategy of the auditing to ensure that their liquidity, the cash flow is accurate and is sufficient for the loan. So because in case we give wrong opinion, that will affect the lenders as well, will affect the client company and may affect the auditor as well. Okay, then we move to learning objective 3, gain an understanding of the client business and industry. So let's say how we can get this understanding of the client business and industry in details. So first, we discuss the factors that have increased the importance of the understanding of the client business industry. So we need to know what is the important factors that will increase and enhance the understanding of the auditor about the client business and industry. One is the information technology. Second is the global operations, and all as well is the human resource. So if we have the information technology, we know the global operations, how the companies operate with the global in terms of import and export. Also, we understand the human capital that will assess the client, understand the client business and industry understanding. What we need to understand, number one, we need to understand the industry and external environment. Next, we need to understand the business operations and process. Then we need to understand the management and governance. So we need to know whether this company or this client company have the board of directors, have CEO, what is the hierarchy of the management? Do they have a kind of strict management, means they don't have many layers of management, so only CEO and then the other stuff? This one will affect, it will show that this company is kind of dictatorship leadership, or it has more stretch or more to call more vertical permit leadership structure, means that the management the top management have another layers of middle management, then operational management, then lower management. So that will drive to this company. It's kind of a big company, and they have certain governance in terms of reporting and in terms of also giving the comments to the and orders to the lower level. And then we need to understand the main objectives and strategies, the vision, the mission of the company client. So we need to understand what is their main objectives for the next coming years and so on. Maybe if it is long term, then we need to understand what they are planning to be in the next 5 years and so on. Okay, then next we need to understand how they measure the performance of the staff and how they measure their own performance in overall of the company. So measuring the performance of the staff should be clearly stated by with the human resource procedure. So if the auditor manage to understand this, then he will get better understanding of the client and the industry as well. Okay, so how to understand the external environment? Reasons of obtaining an understanding of the client, industry, and external environment. Why we need to understand the client, industry, and external environment? Because the company is not isolated in their own, so they need to interact with suppliers, they need to interact with customers to sell, buy and sell. They need to pay also the tax where they are their performance or their work is under the regulations of the government and so on. So they need to interact with everybody in the everybody and even the environment in terms of the atmosphere, the pollution and so on. They need to interact with it, and they are later on is questioning their operation. It may affect significantly their operation in the some future, so they need to bear in mind everything. So auditor need to keep in mind and take note about the client, industry, and external parties. So what is the reasons? We have three main reasons. One is risk associated with the specific industries. This one I had mentioned it in the example that I mentioned just now about the software software industry and so on. Second reason is inherent risk common to all clients in certain industries. So this one is also related. So each industry, let's say we have the industry related, let's say health industry. So all the hospitals are facing the same risk, which is they need to ensure the safety of their staff, doctors, nurse, and so on. Okay, and third one is about the unique accounting requirements. in each industry, which is related to the financial statement. So let's say we are dealing with financial industry. So we have um, some requirements, some specific or unique requirement, which is we don't have much about the inventory. We have more to the cash flow, more to the different items in the financial statements compared to the merchandise industries, different, surface industry is different, oil and gas industry also is different. Okay, because they have different contracting accounting treatment, which is quite different from the other industries. So auditor need to understand the unique risk associated to the specific industry, inherent risk related to that industry, as well as the unique accounting requirements. Okay. Business operation and process factor that the auditor should understand related to the business. One, need to understand the major sources of revenue. So the auditor need to understand what is the major source of revenue for this client company. Is it from let's say if they operate in, let's say in Malaysia, and they have certain client locally and internationally. So what is the main revenue they get from the local um, or the international part? So that one is need to be understood by the client. And also in terms of operations, if they have different three types of product, so which one is giving the major revenue? Okay, so that also need to understand. Then number two is the key customers and suppliers. So that we need to understand who's the key customers and the key suppliers. Is it the suppliers, local suppliers, and they have one unique key suppliers, or they have multi key suppliers? All of that need to be understood to understand how the business is operate and how risky is this kind of business. Okay, number three is sources of financing. And when we say financing, means is they are financing their operation from the equity financing or from debt financing. So we need to check that through their financing statement. I believe it will be in the balance sheet statement, financial position statement. Okay, number four, they need to understand information about related parties. And when we say related parties, mean parties that related to the company. Maybe parties, let's say this company is it's a mother company for another sub companies, or this company is investing with major other companies. So that those related parties will influence the decision of the company. So auditor need to understand those the relationship and how significant are those related parties involved and close to the current company. Okay, and then auditor need to do a visit, or we call it tour the plant and offices. So by viewing the physical facilities, the auditor can assess the physical safeguards over the assets and interpret the accounting data related to the assets. So by visiting the factory, by visiting the offices side, understanding the structure. So if you, let's say I would recommend, let's say for new auditor to go and visit the office or the Department of Accounting and Department of Internal Audit to see the capacity. Let's say they are sitting in the same room, auditors and accountant. So in that case, this one will bring the impression to the auditor if they stay in the same room, and if the auditor is one single person, they are close to each other. So the auditing or the work of the internal auditor will be questionable. Okay, so now then let's move to the to discuss more the identifying related parties. A related parties is defined as an affiliated companies, a principal owners of the client company, or any other parties with which the client deals, where one of the parties can influence the management or policies of the others. So as I mentioned, either they are investing with other companies or other investors investing with big portion of the client company, or the management himself or the managers himself, CEO of this company is investing with other companies. And this company, we need to know, because later on, if there is a huge transaction, if there is intention by the managers to do some manipulation of the financial statement, they may do kind of selling to the other related companies, or buying from the other related companies in order to overestimate or underestimate certain figures in the financial statement, because both this CEO of this of the client company is also key managers in the other company. Okay. Okay, now let's discuss the next point about understanding the client business is the management and governance. What we need, what the auditor need to understand. Auditor need to understand the management should establish the strategies and the process followed by the client business. Okay, so auditor need to say whether they establish these strategies and why they and what is the process to fulfill and achieve these strategies. Okay, and the governance can be defined as the governance includes the client organizational structure as well as the activities of the board of directors and audit committee. Okay, and if they have also the internal audit, if it is a public company, then we will talk about more than one audit, external auditors, and so on. Okay, so we will then within the governance, we will also discuss the corporate charter and bylaws. Then we also code of ethics, meeting minutes, and also the independence of the board of directors members, and so on. Okay. Also, we need to understand corporate charters and bylaws is the corporate charter and bylaw are two documents that are the articles in corporation and internal regulation for the daily running of the corporation. And the charter is a legal document which is created for profit or non-organization. So this corporate charter and bylaws is in the United States, so it's not related to Malaysian case. So because we have what we call the Code of Corporate Governance for the public companies. Okay. We also need to understand the code of ethics. Mostly, we need to understand the response of the Sarbanes-Oxley Act, which asks the Security Exchange Committee Exchange Commission, which is CAC, now requires each public companies to disclose whether has the adopt of ethical. They need to disclose in their financial statement some information about the code of ethics that they follow and implemented in their financial in their process, either in the level of senior management level, or in the operational level. So the Security Exchange Commission also requires the company to disclose the amendment and the waivers to the code of ethics if there is any. If there is any waiving of the code of ethics that by law, then they need to disclose that kind of things. Okay, so then also the auditor, as we said, need to understand the client objectives and strategies. So what is the strategies? The strategies are approaches followed by the entities to achieve organizational objectives. So we understand that strategies is long-term objectives, and we need to know whether they how they achieve it in terms of the short-term objectives and operations. Okay, so auditors should understand the client objectives, in terms of financial reporting reliability. So what is the company objectives in the financial reporting reliability? Do they really feel the reliability of financial statement is essential and very important? And also ensuring the effectiveness and efficiency of operation. Number 3, compliance with law and regulation. Those 3 objectives are the objectives of the client internal control system. If you remember, we discussed it in last week, I believe. So the auditor, when he assess the internal control, he will try to see whether this internal control is achieving or are achieving the 3 objectives here. Okay, and then measurement and performance. So the client performance measurement system include the key performance indicators. So market share. So we are also sales per employee, unit sales growth, website visitors, same store sales, square foot. So all of this is example of the key indicators. And if you notice, those key performance indicators or key performance measurement are not all financial indicators. Some of them are financial indicators. Some of them are non-financial indicators, and for sure they will sequentially affect the financial in indirect way. So the auditor need to understand those indicators in order for the auditors team to understand how the management are assessing or measuring their performance. And then later on, auditor will it will help auditor to evaluate their measurement tools, and as well to justify certain action by the management or the client. So performance measurement include ratios analysis and benchmarking against key competitors. So what we will do, we'll take those key performance indicators and compare it with benchmark of the industry and the key indicators. Okay. Now we move to learning objective 4, assessing the client business risk. Okay. To assess the client business risk, we need to understand first what is the client business risk. So client business risk is the risk that the client will feel to achieve its objectives. Means, let's say the company is selling TVs. and their objectives is to sell TVs and make profit. And their profit should their objectives is to have profit 30% of the assets that they operate, or the profit margin should be 30 to 50%. So if they didn't achieve that percentage, and they make loss, so that we can call that is the risk business related to the client. So what is the auditor's primarily concern related to the client business risk? Assess the auditor concern is to assess the material misstatement in the financial statement due to the client business risk. Okay. So what is the effect or the material misstatement related to the financial statement due to the client business risk? Let me give you example. Let's say we use the example of the client who sell the TV. For example, for this year, they didn't make much business. They didn't sell much, so they make loss. So it is expected this year the profit to be low, or to occur lost, isn't it? But due to the management intention, they want to continue their business, or they want to borrow from bank, or they want to mislead the shareholders. So what they do, they will overestimate the sales income and revenue. So that is the auditor concern. Auditor concern is whether there is a material misstatement in the financial statement due to the client business risk. Okay, I hope that's clear. Okay, let's move now. Let's link the client business risk and the risk of material misstatement. Okay, so number one is understanding the client of business and industry, which we explained just now. Five component of the understanding the industry and the external environment, understanding the business operation and process, and understanding the management and governance of the client, then understanding the objectives and strategies, and finally understanding the measurement and performance. By doing so, we can assess the client business risk. Okay, so why we need to assess the client business risk? To ensure that this risk will not drive to material misstatement in the financial statement figures. I hope this diagram is clear, because it's quite essential to understand it later on when we discuss the assessment of risk and we drive the material misstatement. We need to understand this, because it will drive the understanding of the student or the auditors later on of any phases of the auditing. Let's say the test of internal control, as well as substantive test of transaction and substantive test of details of balance. Okay. Okay, so let's say, what is the Sarbanes-Oxley new title? The Sarbanes-Oxley Act requires that the management certify it has designed disclosure controls and procedures to ensure that the material information about business risk is made known to them. So they need to have this declaration or claim so they need to disclose this. It also requires that the management certify it has informed the auditor and the audit committee of any significant deficiencies in internal control. Okay, so this one we already discussed it. in the, we will discuss it later on in the materiality, and we discuss it also in the internal control. So what we need to understand here is Sarbanes-Oxley is trying to ensure that the management declare and assert and disclose something about the material deficiencies of any internal control. First, they need to tell how sufficient is their internal control, and if there is any deficiencies, they need to disclose it and communicate it to the auditors, external auditors, and the audit committee as well. Okay, let's talk about the enterprise risk management. Enterprise risk management, ARM, has emerged as a new paradigm for managing risk. ARM integrates and coordinates risk management across the entire entities. So it is about risk identifications, risk of evaluation, risk of mitigation, risk of monitoring, and risk of review. So this concept, or this new concept, why we bring it here, I bring it here for the student to understand what is the new requirement for the management to when they assess the risk. So they need to ensure that they identify the risk, and they evaluate how significant is this risk, and how they mitigate the risk, what is the internal control system they established to mitigate this risk, and how they monitor the risk, and how they review that risk. Okay, so this is the framework of the enterprise risk management, which is new concept. So now let's move to learning objective 5 related to perform the preliminary analytical procedures. So when we say preliminary, means initial, in the beginning. In the beginning means we are not doing the analytical procedures in the during, because analytical procedures is about ratios, isn't it? Mainly about ratios, but we still can bring some indicators from non-financial information. Let's say just now what we mentioned just now about the visitors of the website. If we are YouTubers, if the company have YouTube, or they they do some certain advertisement or something like they change the CEO of the company. This is information that not financially can be measured, but it can be used as indicators in our analytical procedures. Okay, so why we say it's preliminary? Because we do analytical procedures in the beginning and in the middle and in completion stages of the auditing. So we will discuss this in short while, what is the difference between the three stages. But what we need to understand here, analytical procedures in the preliminary stage, so it will focus more in the prior years of the financial statement for the client, in order to come out with a better understanding of how the company is performing financially for the last 5 years, let's say, and so on. So we will have it in short while. Okay. The comparison, what is the analytical procedures in the beginning? It is the comparison of client, so comparing the ratios to the industry or competitors benchmarks, provides an indications of the company performance. So preliminary test can reveal unusual changes in ratios. Okay. Examples of planning analytical procedures: we have short-term debt paying ability, which is the current ratio. This is this amount or this percentage is the client, and we compare it with the industry. So it shows that the company is the current ratio or the cash flow of the company is low compared to the industry benchmark. Mean the company ability to pay their ability is low compared to the industry benchmark. So which bring negative indicators. Then liquidity activities ratios related to the inventory turnover, then and so on, profitability ratios and so on. So all of these indicators will help the auditor to understand the client well. Analytical procedures, according to SAS 56, emphasize on the expectations developed by the auditor, and it carry three requirements: required and planning phases. It's required in the planning phases, mean in the preliminary level, and often done during the testing phase. This one is the stage of testing, which is test of control as well as test of substantive test of transaction, and during the test of substantive test of details of balance. And then after the auditor finished the testing phase, then they can conform their findings and their decision by conducting or extending some analytical procedures to just to conform in the completion phase. So if you notice here, this or this table will give us the timing and the process of analytical procedures. So and in the stage of preliminary, which is understanding the client and industry business, at this stage, the require how required is it, how vital it is. So it is primary purpose is main objectives for this stage. We will use the analytical procedures intensively, and it will help in planning phase. But if you see in the assessing going concern, it is secondary process, but we still assess the going concern in the planning stage, and in completion phase is also secondary because we already conduct the testing phase. But for for the stage of indicate possible misstatement or the attention directing, it is primary purpose in the planning stage, secondary in the secondary purpose in the testing phase, and it is primary purpose in the completion phase. And finally, in reducing details of test, it is primary. If you notice that the analytical procedures in the planning phase, it's either primarily or secondarily purpose, but we still need to conduct it in all aims and objectives. So in understanding the client industry business, assessing going concerns, indicate possible misstatement or reduce details of balance. So we need to conduct the analytical procedures. Okay, summary of analytical procedures. They involve the computation of ratios and other comparisons of recorded amount of audit expectation. Next, they are used in planning to understand the client business and industry. Next, they are used throughout the audit to identify possible misstatement and reduce details test, and to assess going concern issues, as we mentioned in the table. Okay, a major process is to gain an understanding of the client business and industry. So the major objective of the analytical procedures in the planning stage is to understand and obtain the understand of the client business in this and industry. Okay, let's say what is the key parts of planning. So accept the client and perform initial planning, new client acceptance and continuous, we already discussed it, and then identify the client reasons of for audit, and then this one we discussed it, the obtaining and understanding with the client stuff, the engagement. So let's say what is the reasons. Understanding the client business and industry, we need to understand the client industry and external environment, as we said, understand the client operation strategies and performing system, as we mentioned in early stage. Then key part of planning, we need to assess the client of business risk, evaluate the management control, effective business risk, assess the risk material misstatement. Actually, those point has been mentioned early. So what we do, we will ignore them. It's kind of revision and repeating. So I will try to amend the slide later on. Okay. Now we move to learning objective number 7, related to the select the most appropriate analytical procedures from among the 5 major types. So we have compare the client data with industry data, similar period year, of the client data itself, and client determine the expected result. So the client uh, the client company put some expectation or planned ratios, so that will also be used for to compare the actual performance with the expected or planned or budgeted process. Then number 4, the audited determined expected result. So auditor will put also certain ratios or certain indicators that he or she expected to have, either through their own experience in the industry or the experience related to the auditing this client business company for the period year. Number 5, expected result using non-financial data, and I did mention this earlier. Okay, what kind of financial information? Okay, so this one I did. This is kind of examples about turnover, inventory turnover, and gross margin. So you can read it in your own. I believe it's kind of something that you study it in several or different subject. I believe financial statement, financial reporting subject, accounting, basic accounting 1, accounting 2, all of this will be discussed on it. So we compare the client company, the client ratios with the industry. Okay, so this is another figures or another ratios related to the client. But if you see, we have 2006 and 2007, so you can compare the 2 years and have the finding. Okay, have the better understanding of the client. Okay, common financial ratios, either short-term debt paying ability, liquidity activities ratios, ability to meet long-term debt obligation, profitability ratios, return on assets or return on equity, and so on. Okay, so this is some formula just to refresh your information, and this one is about the liquidity ratios and days to collect receivable ratios, inventory turnover, days to sell inventory. Then we have debt to equity, times interest earned, and so on. Earning per shares, gross profit percent, profit margin ratios, and this is the profitability as well. So by this we end up we finish. Actually, what I will do, I will revise some point here, and then for KMB1 I will record this chapter again for them in the next Monday, uh, just to have better understanding for the chapter. And then for you, no need to view the video now. uh, I will so next week Monday you can view the record of KMB1. Okay, so any question? Any question up to now?
No, sir, no.
Hello, sir.
No.
Hello,
Hello, sir. I have question.
please go on.
Okay, I wonder what the client business risk example. Can you give example of client business risk?
Okay, when we see client business risk, let's say I give you example of two business, then you can have better understanding, inshallah. We There are two companies. One company is dealing with gold. Okay, so they are selling gold. You know what's gold? Dhahab. The gold, the necklace, the earring for woman.
Yes.
Okay.
Yes, we
Okay.
know.
So selling those diamonds and so on. So this one, they have risk related to their business. What is the risk? Risk of stealing, isn't it? Because
Yes.
they still
Yes.
those kind of stuff. They are selling very expensive stuff, and those stuff are easy to steal. Small thing, small in term of portion. But let's come to those who are selling land, or those who are dealing with assets like buildings and land and so on. Do they have the same risk of stealing the assets?
No.
No, no one will come to steal the assets. What you need to take care of the assets, you need to ensure that this assets uh, has been well taken care in terms of the uh, documentations and so on. So the business risk is related to the business, the risk that may affect the operation in the future. So they operate those who are selling the gold, so they need to have certain controls to ensure that uh, they secure their business from stealing the gold, isn't it? That's why you can say that they have the security with they have gun, isn't it? With in every shop of gold, just to protect
Yes.
the gold. Okay, to protect their goods from stealing. And they have also the design of decoration. They have net and everything is under the CCTV, and every place in the shop are controlled by CCTV and so on. So that is controlling of the business risk. But don't expect that, let's say durian business, they have different type of risk. Durian business, the risk is related to the expiring or spoiling of the durian, isn't it? It's not related to someone will come to steal the durian. It's because it's not wealthy to come and risk the thief to steal one base of durian. It's not wealthy to, so they will take care of, let's say, the risk related to the durian is to having let's say they need to have shadow place or umbrella place to ensure that the sun will not affect the stuff or the durian fruits. Okay.